audio is not coming.
Resurgent India Knowledge Series presents live webinar on fueling growth with equity strategic advantages of an IPO. Moderator Mr. Ritesh Vig, Vice President, Head IPO, Resurgent India Limited. Special invitee Mr. Sudhir Chandi, Director, Resurgent India Limited. Eminent speakers Mr. Arun Kabra, CFO, President Enterprise Business, Times Pro, Times Group. Mr. Sadanand Shetty, Chief Investment Officer, Stellar Asset Managers LLP. Ms. Sonal Mehta, Senior Vice President, Resurgent India Limited. Mr. Shantanu Chaturvedi, Vice President, Transition VC. Mr. Pradeep Gupta, Defense Analyst. Mr. Tarun Mahajan, Registered Valuer, IBBI, CA, CFA.
Yeah, thanks all eminent speakers and our special invitee, Sudhir Chandi sir, who's the director of Research in India. The objective of today's discussion is to understand the strategic advantage of growth capital. In today's discussion, we are understanding the key aspects from our eminent speakers, led by our director, Mr. Sudhir Chandi, Director Research in India. We are trying to understand the perspective of each functional unit that requires for a growth capital through our ecosystem. For that, we would like to thank our eminent speakers for sharing their valuable time and support Resurgent India vision of understand and resolution of clients' problem and society at a large through our various service verticals. Today's key discussion points are capital as a catalyst, strategic timing for the capital infusion, evaluating management capability and governance, order book and dynamics, value chain synergy, equity versus debt. So these key aspects are very, very important for understanding the today's answer to growth capital requirement by most of the promoters. Today we are creating a platform where our ecosystem of the growth capital elements are being represented by Mr. Arun Kabra, who's a born leader, an expert finance, account of accounts, CFO and founding team member. He is a illustrated career spanning over 25 years in FMCG, manufacturing, engineering, insurance, education, and media sectors. He is currently CFO of Times Pro, which is a part of the Times Pro group. Second element of our is Mr. Sadanand Shetty, who is the Chief Investment Officer at Stellar Asset Management LLP, brings over 3 decades of extensive experience in Indian equity markets. recognized for his steady and dependable performance across very market cycles. He has earned the respect of both peers and industry stakeholders for his distinguished career. Third part has been led by Madam Sonal Mehta. She has been very, very instrumental financial professional, over 20 years of experience in investment banking, strategic advisory, corporate finance, both in India and abroad. Currently serving as a senior vice president in Resurgent India at a category one merchant banker with a strong track record in fundraising, merger acquisitions, financial market analysis. Third part is Mr. Fourth part is Mr. Shantanu Chaturvedi. He is a VC head, experienced innovator with a demonstrated history of working in a startup ecosystem, core competencies in scaling the early stage ventures, technology development roadmap, facilitating and innovating consulting strong technologists with vast experience in evaluating technologies from the startup perspective in various verticals, particularly in EV, renewable, IoT, agri-tech, and others. And last but not the least is Mr. Pradeep Gupta, who is distinguished technocrat and ex-bureaucrat, an engineering graduate and PG diploma holders operations management. Besides, he has done special courses from National Defense University, Washington, Harvard School, Cambridge University, UK, Asia Pacific Center, US, Pacific Command at Hawaii, USA. In the government role, he was Private Secretary to President of India, Joint Secretary MHA, oversees the indigestion in Department of Defense Production, MOD. And lastly, is Mr. Tarun Mahajan. He is very prominent in as a registered valuer. He is very keen in understanding the different challenges which is which has been during their valuation assignments. They are what are the challenges are there. He is very very prominent in solving those challenges. Today he's been very very kind to us to join us because he's very very expert in semiconductors, defense, and AI sectors for their valuation. Thank you all for your joining. Now I am introducing our special invitee. He is very, very prominent in dealing different challenges as a profession and most of the for the entrepreneurs. A visionary, Mr. Suri Chandi is a visionary leader, entrepreneur, and financial professional with more than 35 years of experience in various industries, known for business transformation through his varied expertise across various sectors and horizontally equipped with the experience and skill in investment banking, business laws, and valuations. As a director at Resurgent India, he has cultivated a niche in crafting, transforming corporate restructuring strategies that resonate both government and private entities. By profession, he is a CA, registered valuer, and IP. Thank you so much, Sudhir sir, for being us. I would like to take this session with your key comments as a growth capital requirement as on date. Over to Sudhir sir.
Yeah, thank you so much, Ritesh ji, for your kind words. You know, you have been so kind to explain my credentials. I don't know whether I'm worth that or not, but yes, for sure. You know, we at Resurgent we feel proud in taking India to the next level. This is what our theme is, what our motto is. So, thank you so much, everyone, for joining, all the audience, all the eminent speakers, and a very warm welcome to everyone and good afternoon. So, as we all know that investments are an oxygen to the businesses for them to survive, be it private equity, IPO, debt issuances, structured finance, secondary market, anything. Today, these investments are fueling a vibrant and thriving business ecosystem like never before, what we are witnessing today. And like any other developing nation, India also has a very bold vision for the future, making it an economy of 10 trillion by 2032. We are all living that dream. It's very ambitious, it's exciting, and I think it's within the reach, right? But there's the big question. What will it take to get there? It starts from the entrepreneurship. The entrepreneurship must grow. They turn it into SME, then SME turns it into a large corporate, then large corporates goes and to become a global conglomerate. It may take 5 years, it may take 50 years, whatever, everybody has a different life cycle, but, ultimately this has to be the journey to be followed. That's the real journey, I think. It comes with job creation. It forms the basis for a stronger GDP, a more powerful economy. This is what we are seeking for. And of course, government are doing their own job. They are building policies, funding mechanisms, IPO ecosystem, subsidies, knowledge hubs, amazing initiatives like PLI schemes and all. But what's the real challenge? What's the real acceleration? It happens when the investor steps in, not just with the money, but with the vision, experience, and the deep commitment to nurture businesses. And that's why we are here today. Everybody is here today for that, to talk about strategic need for growth capital. And we are very fortunate to have some truly eminent speakers with us who will be sharing their insights and spark new ideas. And here's my take. If we want to build the future, we need massive investments, not just in businesses, but in people, in infrastructure, in R&D, in innovation, and in capacity expansion. But remember, capital alone is not enough. Entrepreneurs need partners who will guide, mentor, walk their journey, provide them funding, of course. But yes, that comes with the best practices, strategic thinking, global insights that can truly transform their businesses. Together, let's build companies that don't just succeed locally, but becomes global model for excellence. That's the future for us to create. So now I hand it over to Ritesh ji and the eminent speakers to take it forward and enlighten the audience.
Yeah, thank you so much, sir, for adding a value that growth capital is not enough. It's a people, process, and technology, and the other stakeholders will be well equipped to vision accomplishment of India's to $10 trillion of economy. So to start from here, I would request Mr. Arun ji to, because he's very prominent in handling lot of startups at the ground level realities as a prominent promoter of most of the startups within the Times Group. Sir, how would you see a growth capital is a key ingredient for scaling a business? Maybe at a time pro, and maybe your experience can be more broadened if you highlight the other parts of other than the time pro also for.
Sure, sure. So see, as such, I mean, growth capital, it is a little bit easier to understand in the context of a company which is having a large spend on R&D, like say a pharma company or a mobile phone company where you have large R&D setups and you think that okay, yes, this is something where we are investing money for future. But when it comes to every other company, growth capital is something which is needed at every level, and especially for those companies who are aiming high. So let me give you an example. Like say, there is a company X which is having roughly 100 crore of revenue. Okay. You are having all the cost parameters well within the range. Probably CM1 is 60%, and then maybe a CM3 level also you are getting good 25-30% margin, and maybe an EBITDA of 20% plus. So it looks good. Okay. But whether the company want to remain at just 100 crore or whether it want to reach to that 1,000 crore, 2,000 crore, 10,000 crore. And if you want to reach to that goal, you need to invest into every aspect of the business. As Sudhirji told, it is the oxygen, right? So if you want to expand, you need to spend into branding, you need to spend into people. You will have to look at certain cost upfront, because it's not like you will hire people today and from tomorrow they will start performing. You will have to have some time till the time your business starts performing at that level. So growth capital is that source which can give you that bridge, that from here to here you want to reach. And this is how this growth capital will give you that leverage, right? It will give you that flexibility, because if suppose you will get a debt which is having an interest burden, or suppose you are getting a specific funding, those things are there for specific aspects of that particular business. That okay, you are getting a LC credit, that is also funding. But point is that is limited to a particular purpose. But when it comes to growth capital, it is generic. It gives you a power that okay, you want to fly, you have this money, you can make yourself fly. So this is what growth capital all about, and it is the most important, but not the only important ingredient, because you need to have a very good revenue model. You need to have a good cost structure. If suppose your business is going to be loss making even after expanding it, then you will actually make more losses. So that should not happen. So all those aspects are relevant, and along with that, the growth capital is also very, very.
Very true. So considering these facts, I may request Sanananji to highlight those points which either Suresh sir or Arunji has mentioned, that not only the growth capital, it's all about the people and the development and the business model. How you evaluate these companies in a different scenario? What are the key elements of your evaluation as a private equity or an pre-IPO investments, or maybe a VC investments? I may come to onto VC investments later.
Thanks, Ritesh. Good afternoon to everyone. Ritesh, current market scenario gives a very good backdrop of one of the theme that you have shared, evaluation of companies in IPO market. So roughly 40% of 2024 IPO companies are today below IPO price. Now, this is one of the important aspect of IPO investment. I'll come to that later. It's about cyclicality of the business. When the cycle of bull overextends, we logically knows more promoters, more companies come to the market with inflated valuations. Something that is witnessed today in a much more normalized market. Fundamental core principle of valuations or analysis has not changed much since the time I have been engaged in terms of research as well as investment since late 90s, predominantly a manufacturing driven economy. I remember covering, some of the sector which is non-existent today, like floriculture, granite, aquaculture. But core principles remain more or less same, although the complexities have changed, the changing public market dynamics, depth of the market, as well as the inclusive nature of the market. So if you go back in 90s, it's much more simpler. Today, it's much more complex. One of the things which remain common is a promoter. We get a lot of pitch from pre-IPO companies, IPO companies, established companies. Promoter remains a common pillar. It's a multidimensional. The evaluation of IPO is a multidimensional. This forum is not enough to discuss it. So I will focus on some key pillars of assessment. How do we do the IPO evaluations? Top 100 companies or top 50 companies in Nifty, excluding government institutions, are largely set up and started by promoters. And they are today phenomenal wealth creator. And they all had IPOs 2 decades back, 3 decades back. That's a differentiation that you could see. Now come back to what happened in last 2 quarters. We are aware of some ambitious promoters have made a total misallocation of capital. And some of these business have destroyed investors' wealth. There is a very recent example just a week back. One of the top e-commerce company supposed to go listing have made a distress selling of its business, almost half or half the valuation of IPO, which were they supposed to raise, or perhaps 1/4 of valuations. You know what happened to this company? Roughly 50% of the revenues has come from a single client. Now this client has run down its business with this e-commerce company, and it had a massive impact on the balance sheet. The point I'm driving it, ambitious promoters, a revenue model. In general, there is a limited data vis-a-vis a publicly listed company, which should have been a decade back, half a decade back, or 2 decades back, to analyze promoters' informations. Today, DRHP provides a significant, it's a gold mine, if you can really go and find out what is the promoter's stakes in the company, pre-IPO, post-IPO. If a promoter is totally exiting or significantly putting its stake through OFS, offer for sale, or money is coming into company, historical track record of promoters, intergroup transaction of promoters. The promoter has gone through a regulatory scrutiny, or there is an audit qualifications. There are group companies which are active in a similar. These are nothing new. We used to analyze this decades back also. Still, all those information remains very, very relevant. We tend to forget promoters' contribution in a bull market. There isn't enough due diligence being done. We see the results of that. Promoters remains one of the key pillar of evaluation that we still do. As I said, it's become much more difficult, if promoter really want to hide something. But there are enough tools. Today, the data is available. Social media data available. They can really go out and find out. One of the other aspect of public issues, which is primarily object of the issues. There are companies which raise capital. Large amount of that capital is a general purpose. When you put a statement like a general purpose, you actually don't know you are giving a free leeway to the promoters to do whatever you want to do. So whether the companies are actually investing in a growth capital, R&D, brand building, market expansions, market, M&A, these are an important aspect that investors should look at it. Besides that, the valuation plays a very important role, fair valuations. In general, in a bull market, when the valuation extends, valuation matrix also changes. I have seen that in my long career. You talk about according to your convenience, you can move around P, you can move around DCF, price to earnings growth. The worst, you can actually go back and say last companies are actually trading below last 5 years valuations. Notwithstanding that out of 5 years, 3 years could be unfair valuations. So there is enough valuation argument being done when the IPO valuation is done. It's very important to look at a valuation from the peer set, a multi-cycle valuation comparison. And one should actually not get carried away, particularly in a bull market. Bull market has a typical signs, we tend to have a greed and fear in the market, but we tend to forget that. There are enough signals available for bull market. Valuation remains a very, very important aspect of it. And the corporate governance. Corporate governance, again, can be looked at whether the company has a criminal prosecution or default. Practically, most of these templates are there. One can actually go and look at it, especially with the institutional investors like us. We at least have an access to management. We can visit, we can meet in person all the promoters, the top management. One need to remember all these key aspects of company prior to evaluating IPO and investing in the companies. Yeah, Ritesh.
Yeah.
Yeah.
Thank you so
Thank you
much
so much
for highlighting the aspects of the growth capital required is to be rightly booked rather than the general purpose, so that it will increase either the capacity or the brand or somewhere adding value to the stakeholders' money. So strictly, I come to the valuation part because you have rightly picked up the valuation is key aspect, which is under value or over value, and during the bull time, the values are being very hefty. So I may request if Tarunji will add some value onto how the valuation is very, very important since promoter is looking for funding and the investor is looking for the right value. As a valuer, how can you help both of them to reach some way mid path in between?
Right, sure, Hitesh. So, one of the things I have seen, fortunately, I have been part of one of the committees set up by Government of India for promoting SME IPOs in India. So, I happen to meet many promoters who are doing mid-sized business. And one of the resistance from the side of the promoters is usually we don't want to go for IPO because a lot of compliances will be there, a whole lot of compliances will be there. We'll have to offer more and more transparency. Currently, we are doing some cash business also, then we'll have to account for every single penny. And we'll have less flexibility. A lot of things will be system driven after the IPO rather than the person driven. These are usually the resistance from the side of the promoters. But on the other hand, I have practically seen some of my very close people also that when they stopped doing the cash business and everything, they started accounted for. And with a better corporate governance, they could focus more on business rather than on hiding their income. And they grew comparatively much faster. So when you come up with IPO, you actually become more disciplined, more regulated, more transparent with a proper governance. And that way you can actually focus on your core competence rather than doing some type of gimmicks or something. Itself enhances your valuation. This is something that one point is. Then see, all of us here understand valuation when we do valuation of unlisted companies. So after doing the valuation exercise with DCF or with the market multiples, we tend to apply a discount for lack of marketability. So most of the people they tend to put some generic number like 20% discount for lack of marketability for unlisted company. So we did research on this for quite a good period of time on pre-IPO and post-IPO study for more than 150 or 200 IPOs. And after doing this analysis, we came to know that if before IPO, share was valued at say 60 rupees, after IPO it was valued at say 100 rupees. So discount for lack of marketability historically through pre-IPO studies appears to be roughly 40%. You put it other way that a share worth rupees 60 before listing is becoming rupees 100 after listing. So there is a rise of more than 50%. So that itself enhances the valuation. When you are putting your money privately, you're putting your equity privately, you tend to command a comparatively lower value. And in the public issue, you will be offering more liquidity, and that way the value will be higher. And as Sadananji has rightly pointed out that if you are coming up with the IPO in the bull's time, then in that case, in most of the IPOs, when you see that what is the rationale behind the value, so people tend to find out the comparable companies and calculate the price to earning ratio, which is one of the most common ways of doing it, and calculate a median price to earning ratio. And then we say that, look, our price is below this price to earning ratio, or it is around this price to earning ratio. When I do valuation, especially for this new age companies, it is really difficult to find comparable companies. And their earning qualities are also really very different. Their managerial depths are different. Their sizes are really different. So price to earning ratio can be just a thumb rule to give a comfort to the price. But when you honestly do the DCF valuation, not playing with the numbers, not doing any gimmick, and you try to project numbers in a realistic manner, you get a more reliable valuation, because you in that case you will be able to uh, focus on each and everything separately, like what is your order book, what are your realistic expectation about the revenue, what the cost may be, how the world economy is going to affect your revenues and cost, how the industry is going to change, how the management style will affect all these things. So that usually DCF in many cases, like in our accounting standards, DCF is avoided because people say a lot of discretionary input goes in. So market multiples are more reliable. But if done honestly, it can give you a better and fair value. So that's what my opinion is on the valuation part.
Okay, thank you so much, Tarunji. So, if the equity is such a tough aspect where the investor is looking in one side and promoter is looking in other side, so the other point which will come onto minds of the promoter is look for the debt. So I may come to Sonal Madam, who is very legend in the debt part. She knows how the banker thinks. So how, Sonal Madam, you can help them in their growth capital, and what would be the right mix of debt and equity if it had to be?
Okay, thank you so much, Ritesh ji, for having me over for this very informative session. And I think, all the speakers have been talking about from the equity perspective. For me, when we're talking about fundraise, so fundraise can be a mix of debt, equity, be it getting in a private equity or a IPO both. So it is very important, that you as a promoter are able to raise the money at the right time and with the right structure. अब वो स्ट्रक्चर जो है वो डेट की फॉर्म में भी हो सकता है, वो इक्विटी की फॉर्म में भी हो सकता है. सो इट विल ऑल डिपेंड अपॉन द नेचर ऑफ द बिजनेस, द साइज ऑफ द बिजनेस, दैट व्हाट इज एन ऑप्शन फॉर रेजिंग फंड. So, primarily, for me, when we talk about debt, is always a cheaper option of raising money from the banks, where probably we are raising money for growing the business without diluting our security or ownership. So, in case given an option, I personally feel debt is a better option. And iske andar, when we're talking about from the SME side of the business, there are various structured options which can be available, like वर्किंग कैपिटल के लिए अगर आपको कुछ चाहिए तो चैनल फाइनेंसिंग वगैरह की ऑप्शंस हैं, वेंडर डिस्काउंटिंग वगैरह की ऑप्शंस हैं which can be available to these SME promoters. But the biggest question here is, I was looking through some data. तो वर्ल्ड बैंक की स्टडी अभी रिसेंटली कुछ इंडियन एमएसएमईज पे हुई थी, जहां पे फॉर्मल क्रेडिट जो हम बोलते हैं, जो कि हम रेगुलर बैंक से पीएसयू बैंक्स हो गए या प्राइवेट सेक्टर बैंक्स हो गए, यहाँ से जो हम फॉर्मल क्रेडिट उठा सकते हैं, उसमें सिर्फ 16% ऑफ द एमएसएमईज आर एबल टू यूज दैट बेनिफिट. The rest of them are not even able to raise that kind of money for the simple reason that do not qualify for the criteria. क्योंकि जो normal banking का structure होता है उसमें वो लोगों को profitability भी चाहिए होती है. Their benchmarks are where they're looking at even the growing companies. Then they also look at security as a structure. So when you're talking about any of the MSME companies today, sometimes they are not able to fit into that criteria. So today there are a lot of other institutional investors who've been coming in to lend money, but still I think this percentage is very very low, and we need to think about it that in case these guys have to go in for a proper debt route, what are the other ways where these guys can go and borrow in the market? So that's a serious thing which we need to talk about. And like I said, that probably any funding option which we talk about has to be a mix of debt and equity both. अब कई बार क्या होता है कि इक्विटी बी इट इन द फॉर्म ऑफ अ प्राइवेट इक्विटी और any angel investor, HNI investor which comes in, or a IPO gives a lot of comfort to the banker to give debt. So that's another perspective from a promoter's thought process to think about कि अगर उनको लगता है कि डेट को रेज नहीं कर पा रहे हैं फॉर द रीजन कि ठीक है जी अभी लेगेसी इतनी है नहीं है बिजनेस के अंदर एंड दे नॉट बीन एबल टू रेज मनी एंड द प्रॉफिटेबिलिटी इज नॉट अप टू दैट मार्क, द सिक्योरिटी इज नॉट there, they can always look at some equity options where these guys can get in some HNI, some seed capital, or if they can get a good valuation, even an IPO. So that will really help them to grow fast and also help them to raise money in the form of debt. So I would say here that, comparatively, if you're talking about debt is always a good option to work on, but there are some situations where you're not able to borrow in the form of debt. There you need to look at multiple options to work on in the form of structured funding.
Yeah. Yeah, thank you so much, madam. Very important point you have raised is the timing of the capital. If the timing is not right, maybe the debt or the equity, then their plans and may not be order book, they cannot be converted into the sales, and their plans will not be get it accomplished. So I cannot discount the presence of Mr. Shantanu Chaturvedi, because he is very, very innovator in different startups, right? Particularly in EV sectors, renewable and IoT, which is the demand of an hour in the form of green energy and AI. So, Mr. Shantanu, now I will come on to you, then I will come to our expert, Mr. Pradeep Gupta. What is your take on to these situations where the promoter is thinking of debt or an equity, and may not be he get the debt, he cannot get the equity. Now we come on to the HNIs, family offices, or the VC funds. So, can you add something onto this?
Um, Hi, good evening, everyone. I'm Shantanu. I'm part of Transition VC. We're an early stage climate focused fund. Thank you, Ritesh ji and Resurgent India for having me. It's a very important question. And a lot of times when I'm interacting with startups, with early stage companies, um, it's it's about the mix of the capital. It's about the right proportions of capital. So there are things where you need debt for, and then there are things that you need equity for. Um, when you're talking about an creating a new business model or creating a new business vertical or creating a new product or you're building something from scratch, typically that's where equity comes in because there is no balance sheet, there is no background, there is no tread line, and getting access to debt in any shape or form becomes very very difficult. So at a very early stage you go to incubators, accelerators for very small grant funding. Then you go a step further, you go to angels perhaps for a smaller check, maybe a crore, 2 crores. Post that, you go to venture capitals for a seed round. Maybe that could be 500,000, that could be anywhere from 4 to 15 crores, 20 crores. And the expectation for Indian venture capital is that post the seed round, or at least post the Series A round, you have a decent enough balance sheet, a decent enough hold on your economics, on your gross margins, on your finances and your financial projections, such that at a seed round or a Series A round, venture debt can start coming in. So, venture debt at a seed round or a Series A round will typically follow a lead investor, a lead equity investor. So, and that typically happens when the equity round is over 10 crore rupees. A venture debt can come in at that point and say, if you're getting 10 crore rupees in equity, we are able to do anywhere from say 20, 25, 30%. I've seen cases go even up to 35% where venture debt comes up. And in the initial days, the ratio is very skewed. So it is far more equity than there is debt. Later on, as your business progresses, as your business matures, the amount of debt increases and the amount of equity uh, drops. We should be very, very clear what the business is doing and what parts are eligible for an equity raise and what parts are eligible for a debt raise. Things like working capital, things like raw material, things like capex, inventory, things like that are typically going to be debt centric. Um, Anything innovative, anything new, getting into a new market, building a new product, building a new business are typically going to be equity centric, and that's how you sort of structure a raise. And it, I, try to get, I would typically say as a thumb rule, being a VC, as much as debt as you can get for any company is the best. And the amount of equity that you need to raise for a business to grow further should be minimized, because equity is considered the most expensive form of capital, because you are diluting shares of the company, which potentially could have a lot of value in the future. So it's all about structuring your finance. It's all about structuring your capital raise. It's all about understanding what sort of capital will be used for what purposes in the business.
So thank you so much, Mr. Shantanu. Now, I would come to Mr. Pradeep Gupta. He is a very, very prominent in handling the different startups which is into the defense, AI, semiconductors, and in the green energy. Sir, what is your thought? Because now you, till the time you have listened, the entire ecosystem is saying about the right mix of debt and equity. I would like to hear from you for our all the parties, all the attendees to understand the fact or your experience. What should be the solution to get the growth capital, the debt, the equity, and how you manage that shows in the past?
Yeah, are you able to hear me? Thank you, Ritesh, for introducing me. Good evening, everybody. I have listened to the previous speakers, like Mr. Sadanand had spoken about the newer areas. Defense is also a newer areas in the equity investment for the general sector, in private sector also. For say last decade and a half, it has come. So before I get on to the details, I'll just like to introduce the defense sector that with the current global geopolitics which is happening, the defense market is pegged at roughly $2 trillion plus, and our share is hardly $30 billion, maybe $35 billion, including the capital and the revenue item what the Indian armed forces will be purchasing through the budget which is given. Obviously, when it is $2 trillion, we must eye for the global market also. So it is the sky is the limit currently for the SME as well as large industry in the country, where we can have see the growth prospects, building on our own national level capabilities. Now, coming back to the main topic, what you have told, that defense sector definitely is a driver for the growing capabilities in the innovation and in key technologies, because every key technologies has come out from the defense only. So while you do the innovation or research, you definitely require uh, capital. Now, capital, obviously, the government industries can do it from the government grants, government support. But then, what about the SME and the private sector? So that they have to approach the market or the individual investors or the VCs or the IPOs, etc. So that way, if you see in the initial starting, obviously they go for the self-funding for the pre-seed or seed level. But then once you are out of that, you have to look for the VC funding or maybe investors P, and thereafter, then once you are comfortable and well settled, then you look for the IPOs. So if you see in that the what I have gone through the literature, at the early stage they depend on the grant, that is the pre-seed or the seed level. Roughly 90 is the grant, or somebody's from the family, or some IDEX type of challenge, they get some money. So to do that, they do it, and 10% equity if somebody is ready to. Then when the growth phase comes, it is roughly 70% is the P and 30% debt. Then the pre-IPO level, the 50%. This is not the for every company, but then just some statistics I came across. 50% is the pre-IPO, and 30% at the pre-IPO level. 50% is the PP, 30% is the IPO. Through IPO you will raise, and 20% the debt. And post IPO, it's a 60% equity, 40% debt, and that is through the investors, etc. What you will be doing. Now, with that, if you see, unlike what other speakers have told, that yes, that will there, but then equity is also very important in this particular domain. Number one. Number two, what Mr. Sadanan also mentioned, that we get the guidance from the equity holders. So that private equity comes, or some good person joins you as an investor, then they will make you able to navigate through the complex defense procurement market. So that is where we can pass through that. So if you see in India, the VC funding for the defense is not very mature. There is definitely a need to carry forward, and I think this today's group can carry this message, and we can invite more and more companies to evaluate the SMEs, and also the SMEs in the defense production sector. Defense production, when I'm referring, it is including the other security areas too, because it is a very, very large set. So there also they can evaluate and see whether the needs can be fulfilled. And also the SME, I will be urging that they look for the global market. They make a product for the global stage. It is very convenient now, because to integrate seamlessly in the global market, and lot of defense exports have been continuously rising. If you see some few thousand crore to now, it is this year, it is 23,000 plus, and we are aspiring to go much higher than that. So this is the target what the government itself wants, and even the SMEs want it. So this is my take on the growth capital, what it about the defense production.
Sure. Thank you so much. So all the panelists today, or the eminent speakers, are of the view to our all the attendees is growth capital is demand of an hour for the vision accomplishment and the growth, and India to reach a $10 billion economy. However, other than the growth capital, it will be the people, R&D man, and different other aspects of their respective business uh, pillars. The equity or a debt is a right perspective is to be mixes to be there for their growth, so that they cannot de-evaluate, they cannot lose their control in the company at a later stage. So equity dilution at a right time is also equally important. Now I come back again to Arunji. On Arunji, what is your take now till the time you have listened for all our peoples today, that debt and equity mix is a right proportion you have rightly picked up, and you also heard about as a uh, money is to be put rightly placed for a general purpose, and for a VC you heard it that debt is the preferable because equity at a later stage has a more value than today, right?
Right.
And you heard about the debt side also. Right. So, what is your take now, considering these as a so that there will be no confusion to all our peoples today? That what is your take in the timing? It's one is the timing, second is the equity dilution versus debt. So, can you add something onto that?
Sure, sure. So I'll remember that thing that what Chanakya had taught all of us. Chanakya told, Rinam Kritva Ghatam Pivet. The person who takes loan, debt, that person drinks ghee. Okay. Means, I mean, that person gets rich. Okay. So that is the, I mean, that is how the entire economy discussion has happened, and that is how we understand that how economics work. But at the same time, we need to understand that what is the timing, okay, so of the business, what is the timing of the market. There are few sectors which may not be receiving that kind of attention at a particular time, then you need to go for that. There is a possibility that you have a very good market, then it is better to go for equity. So, for example, right now we are trumpeting, okay, and we are in a stage where there is a lot of volatility. But at the same time, if suppose anything relating to defense, there is no problem because everyone knows that for defense there is a very, very bright future. Okay. But if something is a typical, I would say, ready-made garment export-oriented unit, okay, what will happen is that people will find that, okay, let us see that whether this is the right time to invest into that kind of company. So the point is that the timing is very, very important. And accordingly, you need to take a decision. Also, what is the cost of your debt? How is your brand looked at by people, by investors? See, IPO is like a retail thing, and in that you will definitely gain something more with reference to a long-term brand lineage. You will get a very good liquidity. But at the same time, if you are going for a private placement, obviously, I mean, your valuations will go a little down because it is a wholesale market then, because you are selling your shares to just one person. So obviously, there will be dynamics around it, but the best uh, time fitment that particular company and the consultants can suggest that, okay, looking at current scenario, looking at your business size, for example, if suppose we are looking at a funding of less than 100 billion, 100 million, then it is better to go for something like a VC fund or something. But if you want to actually raise a large capital and you will still go to only the funds, you will face some challenges there. So, because they would also finally need an exit. So all these aspects are there and very, very relevant. And it's a combination of everything. We need to also look at that how is the regulatory aspect, how is the governance structure of that particular company, how is the governance seen and perceived by all the investors. So there are many factors around it. Timing of the market is very, very important.
Point well taken. Point well taken. So in that light, I may request Mr. Sananji to add value that, okay, it's a mix of the valuation at a time today, because as per SME, dilution is at 26.5% is to diluted, and as per the SEBI, the normal main board is to be 25%. Right. So, considering the fact that promoter is thinking about a long-term growth of their balance sheet, of their valuations, their results will increase, and why should he devalue at 25% today? So, in that scenario, in pre-IPO placements is a right strategy to think about 10-12% dilution rather than as per industry norms of 25%, sorry, regulatory norms of 25% dilution. What is your take? How can you think about that company?
Ritesh, it's a great question. I would also like to focus on larger, sweet spot in the market today. As Shantanu has earlier mentioned, equity is, the costliest something you would incur. So it's always better you go low when you are doing well and dilute later when you create a wealth. That's a short answer for it. But look at this way, you talked about stage of IPO, what stage, companies come and raise capital in public market. Last 2 years, SMEs have close to raise 10,000 crores. Now, these are SMEs. We know the revenue base of this company, maybe 50 crores, 100 crores, 150 crores. Obviously, most of these companies would be growing it around sub 20, sub 30%, or maybe at least sub 20%. Now, imagine these companies are a value chain part of a manufacturing, value chain of a supply services business, which wasn't available in the past. So now the liquidity and the capital is available for this company. So clearly, growth capital will drive the revenue. And many cases, we do see the growths are growing at around 30% CAGR, doubling their revenue in next 4 years. And there's a tremendous appetite. Now look at the another scenario. Here's a company which is at 25 years old, which is the second largest passenger company in India, which actually does OFS, which collects equivalent amount of money, close to 10,000 crores, which is OFS. Yes, we do know that the passenger car is still under penetrated, and the industry would go, maybe high or mid single digit growth rate. So the playbook is available for everyone is here. And that is another big component, which is the private equity guys. If you look at the last 1 year data until now, significant amount of OFS has actually come from private equity guys. Now they got a fantastic exit at whatever valuation is. Now part of that will be recycled against for investment in India, either the risk capital or the growth capital. Today, the IPO market is stage agnostic. I gave you 3 examples. Now look at the asset base. Mutual funds have roughly 53 lakh crores. AIF, which has grown last 5-6 years, has nearly 10 lakh crores. Then PMS, which has close to 6.5 lakh crores. Now, for SMEs, which for mutual funds, market cap might not be eligible because they are small caps, AIFs and PMS are significant contributors. So depth of Indian market is significantly expanded. Now I'm only talking about IPOs. The overall larger liquidity is also available from preferential issues as well as QIPs, where we have seen a significant tractions. So tremendous amount of capital available for a good company. In fact, as Tarunji also said, Pradeep there's a good news for you. There are so many defense companies at the ancillary level are finding a tremendous traction, including our fund. We have committed to invest in an unlisted company, which is a very unconventional for a public market investor to invest in a listed company where the stock is not getting traded every day. Even mutual funds also, they're willing to today invest in an unlisted company which has the growth visibility, long runway. Now, this is the one company where we have committed, actually has a sustainability of the business, growth visibility, and listing plan to be 2 years later. Now imagine the fund which is primarily focused for public listed market, willing to today commit capital, particularly in some of the industries like defense. And it's not that it's easily available. There are many funds who would be chasing for it. So SMEs, we know a lot of, also have the bad words, bad noises about it, but there's a kind of a revolution going around. Having myself has seen it last multiple cycles. So many small entrepreneurs. It's actually a social status. Imagine imagine an area in Gujarat or Chandigarh. The SME entrepreneur goes IPO. His business value is discovered. Maybe 400 crores, 500 crores. His media publicity goes up. The noise about his company, news about his company, suddenly social status go up. We have seen that. We have seen that with the promoters talking about it. ये 500 करोड़ वाला कंपनी है, आदमी है, ये 1000 करोड़ वाला आदमी है. इससे पहले तो सिर्फ फैक्ट्री था, वैल्यू नहीं थी, वो अनलिस्टेड मार्केट में थी. आज लोग बोल रहे हैं कि ये 1200 करोड़ के आदमी है, क्योंकि 12 करोड़ की वैल्यू डिस्कवरी मार्केट में हो चुकी है. So this is a kind of a revolution on that pocket is happening. So we believe there is a significant traction in IPO market. And secondly, look at this way. Traditionally, when I talk about cyclicality, primary market used to have a strong correlation with the secondary market. always. But somewhere that is getting decoupled in a way that today you look at the individual companies, you don't look at the correlation with the larger secondary market. In this market also, we don't find, to sit on, don't find opportunity to get into good company because there are enough guys already on the cap table. In a primary market, it never used to be conventionally. So I believe today's IPO market is a stage agnostic. Companies with a good quality balance sheet, long sustainable runway, there is a tremendous appetite for equity investments. That's my short answer to it, Nitesh.
No, thank you so much, Sananji, for adding something. So, because of the time constraint, I may request to just conclude this session, and we'll take up this session continued individually with all of our eminent speakers to talk about. Because our purpose as a Resurgent India is to whosoever are our viewers or the listeners today, most of them are the promoters. They are looking for the solution. They are looking for the solution because they have their order book, they have their capacity expansion plans. So they have currently the debt to the level of EBITDA times two. So which they think that to get it more funds as a growth capital, they may come. What are their solutions? So within the resurgent, Sonal Madam is helping to our all viewers and promoters to by getting it the right mix of debt. So considering whosoever are listeners, so my take is for today's session is for a growth financial capital is concerned, there are three type of routes. One is the VC capital. Second is you talk about the private equity, then the pre-IPO money and the IPO money. And these are the all solutions at a Resurgent India. I would like to give it at a one platter to our all the viewers. And prominently, the important aspect is that because four or five key areas are emerging as of now, and I'm thanks to Mr. Pradeep Gupta ji sir for being with us. To today, tomorrow we can do maybe sometime a special session on defense, semiconductors, AI, which are the emerging sectors. Because the lot of money, as Sadananji and Shantanu has shared, that a lot of money is there in the market, but the lot of dry powder is there. But this dry powder has to be picked up at the right time. So market are under corrections, so with volatilities has to take care of that part. But in spite of that volatility, we are looking for basically emerging sectors where money is being rightly chased by these fund managers, maybe the VCs or private equity or pre-IPO money. And the promoters on those sectors are always looking for these type of funds to get invested. And then the bankers will come once the equity will be there because there is a lot of money has been put in these emerging sectors by, as rightly said, by the grants initially and by the promoters' money. And then if we see private equity, pre-IPO money will come, then different debt will take their own shape to get the right mix of debt and equity. So I hope our viewers will able to get the answer from these eminent speakers' experience and their knowledge that the promoters are looking for. We at Resurgent India, thank you so much. Thank you all the eminent speakers and the viewers. And hopefully this session will be more resourceful to all the people who are viewers to get
Ritesh,
their
Ritesh,
answer.
Ritesh, there
Yes,
is a
please.
question in the chat box about the defense sector.
Defense sector. I was just about to say, if you
Huh.
can just
Yeah,
take up that question.
you can read, ma'am, and then I'll reply to that. Uh, the question is very important that about the
Okay,
defense.
sir, let me read it for you, sir.
Huh, huh.
So Mr. Hemendra has asked this question. So he is asking that defense is a sensitive area and the orders from the governments only. So orders are coming primarily from the governments only. Doesn't the government look into the funding pattern of the company manufacturing defense equipment and parts?
uh, Defense is a very very vast area. There are some very sensitive items where these things may be taken care of, but then if you see some steel component is there that is also manufactured for the civilian side, automobile sector. lot of you are given the drawing or you do the indigenization under the control, guidance of the concerned PSU or the Armed Forces Indigenization Office. So that happens. So that is there it is not a very critical thing. There are issues, field domains like nuclear. There are some sensitive security products where these things are taken care of, but not in everything. I would say roughly 85% items are not at all we see all these things, because we see then it will be very difficult. But for critical items where we know that it is going to impact, we see all these things. The
If
funding
I
pattern
may,
means some anti-national element is not there.
Yeah, I think this
That
is
is
what
the
the
only thing
crux is.
we see.
Yeah, the
Rest of the thing
money
is to be
coming
seen by
in.
the finance ministry.
That's
if
Violation
I
of any
may,
RBI rules or SEBI rules, MOD doesn't get into that.
Ritesh, if I may add my 2 cents to it. Basically, products are approved by the government, and most of the equipment vendors are large vendors for approved listed companies like Bharat Electronics or HAL or BDL or BEML. Besides, there are regulatory checks are also there. So it get eliminated at the first level only.
Yes.
So there is no such bar as of now. We know the companies like the stock for companies really make cutting edge defense equipment. These are all publicly audited, balance sheets are publicly available. So vendors are basically producing for them. So these are all well scrutinized, well approved, and well recognized. So there is no such bar. It's not even classified as a, from the investment perspective, insensitive or sensitive sectors. In the
Thank you.
public
So
market.
regarding the quantum key that is being used by developed by Q New Lab based at, I think, Hyderabad. I hope that they've also very soon come for the IPO. They are doing good job with the Defense Ministry for making quantum key for communication in the strategic areas. Now we know the founders, everybody know the founders there, so there is no issue about it. If they are anti-national, then definitely, or some Tom, Dick and Harry comes. So that is very closely watched, that who's taking what.
And it's
Automatically it happens.
And Ritesh, it's actually Ministry of Defense, which only approves, or which one will
Yes.
be basically produced by private sector. So there's multiple layer of government approvals only in terms
Yeah, a
of.
lot of government approvals, plus all these project management departments are generally vouched by all the big fours. They are having a project management agency there. So all these bureaucrats, plus there is a consulting organization, all that put together, they take care of the entire process. So
Uh,
all these government tenders have a
yes.
rigorous process of.
That is, and the question has been asked about the funding pattern. Funding pattern normally MOD doesn't get into. Finance Ministry or SEBI will see. We
Yeah,
only
yeah,
focus at the anti-national credentials of that person,
correct, correct.
because he should not pass on the secret to somebody or plant
Absolutely.
something to on our side. That is our main concern. Rest is all you are compliant to SEBI rules. Somebody told about the compliances. You have to follow RBI rules, you have to follow SEBI rules and other MCA rules. So there you are already screened off.
Yeah.
Thank you.
Okay.
Yeah, thank you so much. I think the another point which I would like to add for my all viewers today, that other than the growth, financial capital, which is the people, right processes, right technology, right research, are the integrant part of the growth, and that should be also we can take into account as far as valuation is concerned, as private equity is concerned. So hopefully, thank you so much first to all the eminent speakers. Hopefully, to all the viewers, we are able to give you some resourceful session, and we are looking forward for your all questions. And we'll have separate sessions individually with all the eminent speakers for our better communication and better insights to all viewers. Thank you so much. Thank you so much, Suri Chani sir, for being part of us, and Arun sir, Mr. Tarun sir, Shantanu ji, Pradeep ji,
Thank you.
madam, and to Sadanand ji. Thank you so much, dear.
Thank you so much,
Thank you.
Ritesh, for this session. I
Thanks.
think it was a
Thank you.
very informative session. And thank you to all the speakers for joining in.
Thank you. Thank you.
Thanks all the
Thanks,
viewers
everyone.
and speakers.
Thank
Thanks.
you. Thanks. Bye bye.
Bye.
Thank you.